Welcome back to the deep dive. Today we are really getting into the weeds with Teva Pharmaceutical Industries Ltd. You probably know them as Teva. Now, this is a company that for years was basically the textbook definition of a pharma giant, known everywhere for, high volume, low cost generics. But that old playbook, it's just not enough anymore. Teva's in the middle of this incredibly demanding corporate restructuring. It's a multi-year thing they're calling the pivot to growth. So, our mission today for this deep dive, we've got a pile of their latest Q2 2025 financials, analyst reports, all detailing this big strategic shift. And we need to figure out, is this giant actually turning the ship towards, let's say, a sustainable future based on innovation? Or are they still, like some people worry, kind of treading on thin ice? And the tension here is, well, it's pretty stark, almost existential, you could say. Operationally, yeah, Teva's telling a good story. 10 straight quarters of year-over-year revenue growth. Q2 2025 looks strong. Looks like they found their footing right, but and it's a huge but. Balancing all that growth is this absolutely massive historical debt load. We're talking, around $17.2 billion in total debt as of the end of Q2 2025. Just to give you some perspective on that number. That debt, it's roughly 4 times the entire annual revenue they expect from their innovative drugs this year. So this pivot isn't just a nice idea, it's an absolute must-do for survival. That debt, it's like this huge gravity well influencing every single decision. Okay, let's unpack this. Let's start with the strategy itself, the plan designed to fix this financial mess.
Right. And this pivot to growth, it's really more than just, tweaking the product mix. It's a fundamental shift in how the company thinks and operates. For decades, Teva was generics. I mean, even in 2024, generics still made up, 57.2% of their total revenue. And generics, that's all about logistics, scale, razor-thin margins, really cutthroat pricing. The new vision, the strategy, is to become a more balanced biopharmaceutical company. The focus is shifting heavily towards these higher-margin, innovative specialty medicines. They laid this out back in May 2023. It's got 2 explicit phases. Phase 1, the return to growth. They basically nailed that. Those 10 quarters of revenue growth are the proof. So now we're firmly in the acceleration phase. And this phase, it needs speed, it needs discipline. It's built around 4 main pillars all working together. First pillar, delivering on growth engines. Pretty straightforward. This is all about squeezing every bit of performance out of the innovative drugs they already have. We're talking the big 3, AUSTEDO for movement disorders, AJOVY for migraine, and UZEDY, the newer one for schizophrenia. These have got to deliver big, sustained revenue. That's the cash flow engine right now.
Okay, maximizing the current winners. Makes sense. What's pillar 2?
Pillar 2 is stepping up innovation. So this is about the future. It means pushing harder and faster on their late-stage R&D pipeline. Because honestly, the long-term health of Teva, especially their profit margins after, say, 2027, it almost completely depends on getting those pipeline drugs successfully through trials and onto the market on time.
Right, feeding the beast for the future.
Exactly. Then pillar 3 is sustaining the generics powerhouse. Now, they're not ditching generics entirely. That would be crazy. But they're redefining its role. The generics business, along with biosimilars and their over-the-counter stuff, it needs to stay stable. It's maybe not the growth engine anymore, but it's the critical, massive cash flow generator. That cash funds the R&D, and crucially, it pays down that $17.2 billion debt. It's really the engine room for the whole pivot.
So generics pays the bills while innovation builds the future.
That's a good way to put it. And finally, pillar 4 is focusing the business. This is all about optimization. Ruthless optimization, really. Streamlining how they operate, simplifying their global manufacturing network, and selling off assets that aren't core to the new strategy, assets that distract management or tie up needed capital. The biggest example here, and it's happening now, is selling off their Teva API business. API is active pharmaceutical ingredients. It's the raw drug components.
Ah, so the actual chemical manufacturing part.
Precisely. It's historically important, sure, but it's a different kind of business, often very cyclical. Selling it helps them focus squarely on developing and selling finished specialty drugs. They've said the sale is in active and advanced discussions, expected to wrap up in Q3 2025. That sale is key to hitting cost-saving targets, too.
Okay, so a 4-pillar strategy. Maximize current winners, accelerate the future pipeline, keep the generics cash flowing, and streamline everything. Seems logical. And when we dig into the Q2 2025 numbers, you can actually see this strategy starting to bear fruit, right? The momentum seems real. That top-line result, the $4.2 billion in Q2 revenue, that's a big deal. 10th quarter in a row of year-over-year growth, even up 1% in local currency if you take out the Japan business they sold. That kind of steady, predictable growth is exactly what they need to show the market this pivot is working, not just some random blip.
Absolutely. Predictability is key when you're trying to rebuild trust.
But I think you'd agree the really exciting part isn't just the revenue, it's the profitability. That shift, driven by selling more high-margin stuff, the non-GAAP operating margin jumped to 27.1% in Q2. That's up 170 basis points from the year before. That's significant.
It really is.
Yeah.
And why is that margin number so critical? Because those innovative drugs, AUSTEDO, UZEDY, they just carry much, much higher margins than selling bulk generics. You saw it in the gross margin, too, on a non-GAAP basis. Hit 54.6% in Q2, up from 52.9% a year ago. Every single point of margin improvement, that translates directly into more cash. Cash they desperately need for that debt.
Yeah, let's talk about that GAAP versus non-GAAP thing for a second, because it really tells the story of old Teva versus potentially new Teva. You mentioned that back in Q3 2024, they had this huge GAAP loss, like $390 million.
Right. In GAAP, the generally accepted accounting principles, it forces you to include everything, all the historical baggage. That loss, it was mostly driven by $450 million in legal costs. Things like the opioid settlements, price-fixing settlements, plus those massive goodwill write-offs from past mistakes. Non-cash, mostly, but they reflect real financial damage from the past.
So GAAP shows the whole messy history.
Exactly. But non-GAAP, it strips out those kinds of items. It aims to give you a cleaner view of how the current business is actually performing operationally. And the turnaround is clear when you look at it that way. Operationally, the business is now healthy enough that even with some of that historical weight, Teva actually reported positive GAAP net income in Q2 2025, $282 million.
Wow, okay. So the core operations are finally strong enough to start absorbing the costs of the past.
That's the signal, yes, is the first real sign.
And on that adjusted basis, the non-GAAP diluted EPS, earnings per share, was $0.66 in Q2. That's up 10% year over year. Respectable. And clearly management felt good about it because they raised the bottom end of their full year 2025 guidance, now expecting $2.50 to $2.65 per share. Tighter range, higher floor.
That guidance raise is another important signal to the market, confidence.
But let me push back a bit here, play devil's advocate. You mentioned the, what was it, $28.3 billion in cumulative goodwill write-offs by early 2024. That's staggering, mostly from that disastrous activist generics deal.
I have the big one, yes.
We've seen other companies promise a turnaround, a clean slate, only for more historical baggage to suddenly appear later. So is this 27.1% non-GAAP margin the real deal, the new normal? Or is it just a temporary peak before more cleanup costs hit the books?
That is absolutely the right question. The 27.1% is today's success story. But the real measure, the validation of the pivot, lies in the future targets. And this is where, well, what's fascinating here is just how ambitious they are. Management is publicly targeting a 30% non-GAAP operating margin by 2027. 30%.
30%. Okay, how do they get there from 27?
Two big things have to happen at the same time. First, that gross margin needs to expand even more dramatically. They're aiming for 57% to 58%.
Which means the innovative drugs, the big three, have to keep growing much faster than the rest of the business, right?
Yeah.
Displacing lower margin generics revenue.
Precisely. That product mix shift has to accelerate. And second, they have to clamp down hard on operating expenses, OPEX. They're targeting a tight range of 27% to 28% of revenue for OPEX. The whole success of this acceleration phase really hinges on hitting that 30% margin. It means proving the new operating model is lean enough, streamlined enough to sustain it. And that requires, as I said, ruthless cost management. We'll get into the savings program specifics later.
Okay, so that heroic product mix shift puts enormous pressure on the commercial side, but it makes total sense when we actually look at the drugs driving this. The combined innovative portfolio, AUSTEDO, AJOVY, UZEDY, it's projected to grow around 23% year over year in 2025. That's huge, expected to bring in about $2.9 billion this year alone. Let's start with AUSTEDO. Movement disorders, tardive dyskinesia, Huntington's chorea. This is the flagship, right? The main engine.
Absolutely.
Yeah.
It's the cornerstone.
Q2 global revenue, $498 million, up 19% year over year. Almost all of that, $495 million, coming from the U.S. And they were so confident, they bumped up the full year 2025 outlook for AUSTEDO, now expecting $2.0 billion to $2.05 billion. That's a monster drug.
It is. And critically, notice the strategic push towards AUSTEDO XR. That's the once-daily extended release version.
Right, instead of twice a day. Why is that so important? Better compliance.
Exactly that. Management was very clear. Moving from twice-daily to once-daily dosing is a game changer for patient compliance and adherence, especially for chronic conditions. Think about it. Improving adherence, even by just 10 or 20%, it doesn't just boost revenue for Teva, it fundamentally improves patient outcomes. That's the clinical selling point.
Makes sense. Fewer missed doses, better control.
Right. And the long-term peak sales target for the whole AUSTEDO franchise, they expect it to go north of $3 billion. That anchors the entire innovative portfolio. And that switch to XR is happening fast. They said over 60% of new patients are already starting on XR. The expectation is it becomes the standard of care purely because it's easier for patients.
Okay, $3 billion plus potential from AUSTEDO. What about UZEDY, the schizophrenia treatment? That one seems to be growing explosively.
It really is. UZEDY showcases their expertise in complex drug delivery. Q2 revenue hit $54 million. Now, that sounds small compared to AUSTEDO, but it was up a whopping 120% year over year.
Wow.
And because of that trajectory, they raised the 2025 outlook significantly, now $190 million to $200 million for the full year.
And it's a long-acting injectable, an LAI. Why is that form factor important in schizophrenia?
Hugely important. Adherence, again. Sticking to daily medication can be very challenging for patients with schizophrenia. LAIs, given maybe once a month or even less frequently, dramatically reduce the risk of missed doses and relapse.
Right.
And UZEDY has some real advantages. It's subcutaneous, so an easier injection than some others. It reaches therapeutic blood levels within just 24 hours. That's fast onset. And, crucially, it uses their proprietary SteadyTech technology.
SteadyTech, what does that do?
It's a delivery platform that stabilizes the drug formulation. Two key benefits. One, it provides smooth, consistent drug release over the dosing period. And two, it means UZEDY doesn't need refrigeration. That's a big practical advantage for clinics and patients.
Okay. Logistics matter. And where are the patients coming from? Is it stealing share from other LAIs?
That's the interesting part. The data shows over 80% of new UZEDY prescriptions are actually coming from patients switching from daily oral antipsychotics or patients who are completely new to therapy.
So they're expanding the LAI market, not just fighting over existing patients.
Seems like it. It suggests their sales team is effectively communicating the clinical and practical benefits, convincing doctors and patients to move to a long-acting form. And this product, combined with another one in their pipeline, Olanzapine LAI, which we'll touch on later, that's going to form Teva's big LAI franchise in schizophrenia. Management thinks that combo could hit $1.5 billion to $2.0 billion in peak sales together.
Okay, a powerful 1-2 punch, potentially. Let's round out the big three with AJOY for migraine prevention.
Right. AJOVY Q2 global revenue was $155 million. Strong growth there, too, up 31% year over year. That led them to raise the 2025 outlook to $630 million to $640 million.
Now, the migraine market is crowded, isn't it? Lots of competition.
Incredibly crowded. AJOV is an anti-CGRP injectable. CGRP, calcitonin gene-related peptide, targeting that is the modern standard for migraine prevention. But AJOV faces tough competition from other injectables, plus a whole new wave of oral CGRP drugs.
So how is it still growing so strongly?
Commercial execution. Pure and simple. Despite all that competition, especially the convenience of the oral options, AJOVY is still the #1 injectable anti-CGRP in new prescriptions at the top U.S. headache clinics. And internationally, it's the market leader in 29 countries across Europe in their international market segment. It just shows that Teva's pivot isn't just about having the drugs. It's backed by a sales and marketing organization that knows how to compete effectively, even in tough, high-margin categories.
Okay, so the innovative side is definitely providing the high-octane fuel. But you mentioned Pillar 3, sustaining the generics powerhouse. That's still the foundation, the cash engine. How's that segment actually performing? There was some noise about volatility.
Yeah, there was. Global generics revenue was down 2% in Q2 in local currency, if you exclude that Japan sale.
Down 2% for the cash engine. That sounds a little concerning on the surface.
It does, but the context, again, is absolutely crucial here. That decline looks bad, mainly because the comparison period, Q2 2024, was unusually strong. Q2 last year had these massive, but ultimately one-off boosts from major new generic launches in the U.S. The generic version of Victoza was a big one. Those kinds of launches create huge spikes in revenue that just aren't sustainable quarter after quarter. So management argued pretty convincingly, I think, that if you strip out those big launch effects from last year, the underlying base generics business in the U.S. actually looks pretty stable, resilient even. It's a mature business, but it's holding its own.
Okay, so the base business is solid, but susceptible to these big launch spikes messing with the year-over-year numbers.
Exactly.
Right.
But there is still real volatility in specific areas. The big one is generic Revlimid.
Revlimid, the cancer drug, that's a huge generic market.
Massive.
Yeah.
And a big revenue driver for Teva globally. But they flagged increasing uncertainty around Revlimid sales. It seems like ordering patterns are changing, maybe more competition is coming online faster than expected, and that uncertainty is particularly clouding the outlook for the fourth quarter, Q4.
So even the stable generics engine has unpredictable parts.
Oh, absolutely. That's the nature of the beast in generics. Constant pricing pressure, unpredictable market dynamics. The tough business to forecast precisely.
Given that pressure and the eventual erosion of big generics like Revlimid, you said the long-term plan relies heavily on biosimilars, right? To
Yeah.
kind of backfill that cash flow.
Yes, biosimilars are absolutely central to the long-term stability of Pillar 3. Think of them as a bridge between traditional generics and innovative drugs.
How so? They're still generics, aren't they? Copies of biologics?
They are copies, yes, but copies of large, complex biologic drugs, not simple chemical pills. That means they're much harder to develop and manufacture. They require significant clinical data packages for approval. So the barriers to entry are higher than for simple generics. That generally leads to fewer competitors, less drastic price erosion, and therefore higher and more sustainable margins.
Ah, okay. More complex, higher margin, more durable revenue. Makes sense.
And Teva's playing this strategically. They call it a portfolio play. They have 13 biosimilars in their pipeline right now. And the goal is ambitious. They want to basically double their biosimilar revenue to around $800 million by 2027.
Double it. How are they going to do that?
Launches. They've already had significant recent launches that show they can execute in this complex space. Simlandi, that's their biosimilar of Humira, a huge drug, and Solarsdi, biosimilar of Stelara, both big immunology drugs. And they're expecting 5 more biosimilar launches between now, the second half of 2025, and the end of 2027.
Okay, so the strategy is clear. Intentionally swap out that volatile, low-margin, simple generics revenue over time and replace it with more predictable, higher-margin, complex biosimilar revenue.
That's it, exactly. It creates a safer, more stable cash flow stream to support the whole company transformation and, critically, to tackle that debt.
Which brings us back, inevitably, to the debt. Here's where it gets, as you said, really interesting. Because no matter how good the innovative growth or the biosimilar strategy is, that $17.2 billion number just looms over everything. End of Q2 2025.
It absolutely does. It's the elephant in the room, always.
And just to remind everyone listening, this isn't new debt from the pivot. This is the toxic legacy of those huge debt-fueled acquisitions from the past. The big one being buying Allergan's generics unit, Actavis, back in 2016 for $40.5 billion. That's the financial hole they've been clawing their way out of for years.
And you see that history written all over their balance sheet. I mean, total assets are huge, over $41 billion. But drill down, about $16.7 billion of that, as of Q1 2025, was goodwill and intangibles.
That's basically the premium they paid over the actual asset value in those deals, right?
Paper value.
Paper value, exactly. And the market eventually called them on it. Those massive impairment charges you mentioned earlier, the $28.3 billion write-down by early 2024, that was the painful reality check. It underscores just how big the past mistakes were and why this pivot is so absolutely necessary.
So the goal now isn't just growth. It's survival through deleveraging, getting that debt down. Existential deleveraging, yes. And the target is incredibly aggressive. Get the net debt to adjusted EBITDA ratio down to 2.0x by 2027.
2 times leverage. Where are they now?
Right now, if you take their latest debt number and the midpoint of their 2025 adjusted EBITDA forecast, they're sitting just under 3x, maybe around 2.9x.
So they need to shave off almost a full turn of leverage in about 2.5 years. That means generating billions in free cash flow consistently.
Billions. And directing every spare dollar towards paying down debt principal. That's the only way.
The market must be watching their every financial move like a hawk. Are we seeing signs they're managing this effectively?
We are seeing positive signals, yes, which is crucial. For instance, just in Q2 2025, they proactively refinanced $2.3 billion of debt that was coming due soon.
Pushing out maturities, buying time.
Exactly. Extending the runway, smoothing out the repayment schedule. That's smart financial hygiene, especially with interest rates where they are. Reduces near-term pressure. And this kind of proactive management, combined with the improving profits we talked about, it is being noticed. The credit rating agencies, Moody's and Fitch, both upgraded Teva's debt rating recently. Moody's to B1, Fitch to BB+ on, still below investment grade, but moving in the right direction.
Those upgrades matter, right? Lower borrowing costs, signals more confidence.
Absolutely critical. It makes future refinancing cheaper and tells the market that the experts who scrutinize balance sheets believe the turnaround plan is credible and they're on a path to better financial health.
But refinancing only helps so much. They need actual cash, which means cutting costs, right?
Mm.
That savings program you mentioned.
Yes, the operational surgery is key. They have a formal program aiming to deliver $700 million in net annual savings by 2027. That $700 million, because it's net savings, it drops almost straight to the bottom line. It's absolutely vital for hitting that 30% operating margin target and generating the free cash flow needed for debt paydown.
$700 million is a big number. How much progress have they made?
They reported they've already executed about 20% of that goal. That translates to an annualized run rate of savings around $140 million already locked in.
And how are they getting those savings?
The usual levers for a restructuring of this scale. We know it includes significant headcount reductions, about 8% globally, and simplifying their manufacturing and supply chain network. Closing facilities, optimizing logistics. These are hard decisions, but necessary to hit those 2027 leverage targets. And that Teva API divestiture we talked about, selling that business, expected to close soon in Q3, that will also contribute significantly to streamlining operations and hitting those savings goals. Focuses the whole organization.
Okay, so the debt is huge, the deleveraging target is aggressive, but they seem to be making the right operational moves and managing the finances proactively. Still a long way to go, though. Now, even with AUSTEDO, UZEDY, AJOVY firing on all cylinders, that growth won't last forever. Patents expire eventually. They need new blockbusters coming through the pipeline to keep the momentum going past 2027, right? Especially after that initial debt cleanup phase.
Absolutely. Pillar 2, stepping up innovation becomes paramount after 2027. Management is very clear. The late-stage pipeline assets are the next wave of growth, and potentially a big wave. They're talking over $10 billion in combined peak sales potential from these key assets.
$10 billion potential. Okay, what's the star of that pipeline?
The biggest one, the anchor, is probably Devacrug. It's an anti-TL1A molecule.
Anti-TL1A, what's the target disease?
Ulcerative colitis and Crohn's disease. Inflammatory bowel disease, or IBD. That is a massive market, billions and billions in annual sales globally for effective IBD treatments. And anti-TL1A is a relatively new mechanism of action. TL1A is a protein involved in driving chronic inflammation and fibrosis, the scarring in the gut. So the idea with Devacrug isn't just to manage the inflammation like older drugs, but potentially to actually halt or maybe even reverse some of that tissue damage that makes IBD so debilitating.
Wow, okay. Disease modification potential. That's huge. Where are they in development?
They're getting ready to start the big Phase 3 program, expected to kick off in the second half of this year, 2025. These will be large trials, over 1,000 patients for each indication. UC and Crohn's. The peak sales potential they're throwing around, $2 billion to $5 billion, just for this one drug.
2 to 5 billion. But IBD is notoriously competitive, right? Lots of drugs, big players.
Brutally competitive. And that's why there's a critical data point everyone is waiting for. It's the Phase 2b maintenance data for Devacrug in IBD, expected in the first half of 2026.
Maintenance data. So does the effect last long term?
Exactly. Does the drug keep working well after the initial treatment phase? If that data shows the effect fades over time, that multi-billion-dollar peak sales number could evaporate pretty quickly. So the stakes on that 2026 data readout are incredibly high for Teva's long-term story.
Okay, Devacrug, huge potential, big clinical risk pending. What else is key in the late pipeline? You mentioned another schizophrenia drug.
Yes, building on UZEDY's success, they have Olanzapine LAI, another long-acting injectable for schizophrenia. This really cements their strategy to build a major franchise around improving adherence in this patient group.
Olanzapine. That's an older, well-known antipsychotic, isn't it?
It is very effective, but the existing injectable versions have a serious safety issue, a black box warning for something called PDSS.
PDSS.
Post-injection delirium sedation syndrome. It's a rare but potentially life-threatening event where the drug gets into the bloodstream too fast after injection. Causes deep sedation, delirium, sometimes requires hospitalization. It's a major barrier to using current Olanzapine LAIs.
Okay, that sounds serious. How is Teva's version different?
They're using that same steady tech delivery technology as UZEDY. And the key claim, the major potential advantage, is safety. Management has repeatedly emphasized that no cases of PDSS have been reported in their clinical trials to date.
None at all. If that holds up, that's a massive differentiator.
Huge. If they get approval without that PDSS risk, or with a significantly reduced risk profile, it could make their Olanzapine LAI much more attractive than competitors that require lengthy post-injection observation periods. That's why they feel comfortable projecting, combined with the UZEDY, peak sales of $1.5 billion to $2.0 billion for the LAI franchise.
When might this Olanzapine LAI get filed?
They're anticipating filing the new drug application, the NDA, in the second half of 2025. So approval could potentially come sometime in 2026.
Okay, so that's potentially launching relatively soon. What else? The pipeline seems diverse.
It is. They have the DRI, which stands for Dual Action Rescue Inhaler for asthma. This is interesting. It aims to be the first combination of an ICS, an inhaled corticosteroid, like a daily controller, and a SABA, a short-acting beta agonist, like a rescue inhaler, in a single device, used only when needed for symptoms.
So instead of just using a rescue inhaler, you get the controller medicine at the same time during an attack.
That's the idea. Treat the immediate symptoms and the underlying inflammation simultaneously, event-driven. Could change how rescue therapy is approached. Phase 3 enrollment is supposed to wrap up by the end of 2025. Peak sales potential here is estimated around $1 billion. It's aimed at reducing severe asthma flare-ups.
Interesting concept. And one more major one.
Yes, one more that's high risk but potentially very high reward. Emrusolmin. This one targets a devastating disease called multiple system atrophy, or MSA.
MSA. I know that's a rare progressive neurodegenerative disorder, right? Similar to Parkinson's in some ways, but faster and fatal.
Exactly. And crucially, there are currently no approved treatments that modify the course of MSA. None. Emrusolmin works by targeting the aggregation of alpha-synuclein protein, which is implicated in MSA and Parkinson's.
So, huge unmet need. If it works.
If it shows a real benefit, the potential is enormous simply because there are no other options. They mentioned Phase 2 enrollment is going faster than expected, which is a good sign operationally. Because of the orphan disease status and lack of competition, they estimate peak sales potential at over $2 billion.
Wow. Okay, so Devacrug, Olanzapine LAI, DRI, Emrusolmin. That's a pipeline with serious potential, but also clearly significant clinical hurdles still to clear.
Absolutely. That $10 billion plus peak sales figure is potential, not guarantees. Execution is everything.
Yep.
And, if you try to connect all this back to the bigger picture, all the strategy, the financials, the pipeline, it all has to be viewed through the lens of external risks. And importantly, how the market is currently pricing in those risks. Valuation.
Right. What are the big external clouds hanging over this?
Well, the most immediate one, certainly in the U.S., is regulatory risk. Specifically, the Inflation Reduction Act, the IRA. Teva is, right now, actively negotiating the price of AUSTEDO with CMS, the Centers for Medicare and Medicaid Services. AUSTEDO was one of the first drugs selected for IRA price negotiation because of its high Medicare spending.
The price negotiation. That's a huge unknown, isn't it? How much of a discount will they be forced to take?
Exactly. And management is understandably staying completely silent on it. They declined to give any hint about the expected discount range while talks are ongoing.
But even say, 10 or 15% mandated discount on AUSTEDO, that would take a significant bite out of that $3 billion peak sales number we talked about, wouldn't it? Since Medicare is a huge payer.
A huge bite. That negotiation risk is definitely a major overhang on the stock right now. The uncertainty is baked into the current valuation, no doubt.
What about other risks? Trade wars, tariffs? They're a global company.
They addressed that. Management sounded pretty confident about tariffs, actually. They said they have very little reliance on China for critical raw materials, key starting materials. They emphasized they're well-diversified. In fact, they pointed out that over half the products they sell in the U.S., including the flagship AUSTEDO, are actually manufactured right here in the U.S., so less vulnerable to potential U.S.-China trade issues.
That's good diversification. What about Europe?
There, they acknowledged a bit more uncertainty, specifically about the impact of recently announced European tariffs. It wasn't clear how those might affect their extensive operations across Europe and other international markets. So something to watch.
Okay, so IRA pricing is a big known unknown. Tariffs, maybe less so for the U.S. What does this all mean for how the market actually values Teva today? You mentioned it seems undervalued.
It does, if you just look at the standard metrics compared to peers.
Yeah.
Their forward enterprise value to adjusted EBITDA multiple is hovering around 6.5x.
6.5x, how does that compare?
It's significantly lower than you typically see for a specialty pharma company that's projecting 23% growth in its main innovative drugs. Peers with that kind of growth profile often trade at higher multiples, maybe 8x, 9x, or even more.
So the market is discounting them heavily. Why?
Execution risk, plain and simple. That discount reflects the market's skepticism about whether Teva can actually deliver on all these promises. We look at some intrinsic value estimates based on detailed financial modeling. A discounted cash flow model put the value around $22.50 per share. Another method, the owner earnings model, suggested even higher, maybe $25 per share.
And where was the stock trading when those estimates were made? Late May 2025.
Closer to $17.40. So
Yeah.
you see that gap, roughly $5 to $7 per share between the modeled fair value and the actual market price. That gap is the market pricing in the risk.
The risk that, what, they missed the savings target.
That's part of it. The risk they fail to hit the $700 million in savings. The risk that Devacrug maybe fails in phase 3 or Olanzapine LAI doesn't get that clean safety profile. The risk the IRA negotiation forces a really deep discount on AUSTEDO. And maybe most importantly, the risk that all these things combined mean they miss those critical free cash flow targets needed to hit the 2.0x debt leverage goal by 2027. That's the big one.
But if they do hit those targets, what's the potential return?
The incentive is definitely there. The modeling suggested a potential 5-year internal rate of return, an IRR, of around 18.5%. That's a very compelling return for investors.
Almost 19% IRR, but only if everything goes right.
Pretty much. That return is entirely dependent on them generating that massive free cash flow, getting over $2.7 billion in FCF in 2027, and pushing past $3.5 billion by 2030. If they miss those FCF numbers, they miss the debt targets, and that attractive IRR just vanishes. High risk, potentially high reward.
Okay, that brings us pretty much full circle on this deep dive. If we had to summarize the aha moment, what is it?
I think the main takeaway is that Teva genuinely seems to be changing its fundamental nature. The shift away from being just a generics giant towards a balanced biopharma company, it looks real this time. You can see it clearly in the numbers. The accelerating high-margin growth from AUSTEDO, UZEDY, and AJOVY is successfully offsetting the sluggishness or declines in older products, and it's driving real margin expansion, which is crucial.
So they've managed the return to growth phase, now they're in the acceleration phase, and the success of this whole thing really boils down to just a couple of absolutely critical factors now.
I'd say 2, and they're tightly linked. First, can they deliver that $700 million in net savings and keep driving operational efficiency to hit that 30% non-GAAP operating margin target? Ruthless execution on costs. And second, can they successfully bring those big pipeline drugs, Devacrug, Olanzapine, LAI, especially through the final hurdles of development and onto the market in a timely way? The science has to deliver.
Because without those future blockbusters, the growth eventually stalls again.
Exactly. This whole transformation, it was strategically necessary. They really had no choice, given the pressures in the global generics market. Management's laid out a clear plan, and to their credit, they've shown some initial results, growing revenue, better margins, smarter debt management, that have started to build back some confidence, even with that massive debt still sitting there.
Right. That target, get net debt down to 2x adjusted EBITDA by 2027. It all comes back to generating enough cash to hit that number. If you're watching this company, whether as an investor or just an observer of corporate turnarounds, you're almost betting more on the CFO's ability to execute this massive debt cleanup than just on the scientists discovering the next wonder drug.
It's a finance story as much as a science story right now.
Absolutely. So here's maybe a final thought for you, our listener, to consider. What does it really tell us about the state of, let's say, specialty pharmaceutical finance today when you have a company like Teva with genuinely strong growth in its innovative drugs, but its valuation is so heavily discounted? Not primarily because people doubt the science or the market for the drugs, but because the success of those multi-billion-dollar therapies is measured first and foremost by whether they generate enough free cash flow simply to pay off the debts incurred by mistakes made years, even decades ago.